Rich Bonn, welcome to Jewish Money Matters. How are you?
I'm great, Baruch Hashem. It's wonderful to see. Okay, it's weird seeing you on video because I'm so used to getting to see you in person.
Yeah, I'm like a few blocks away.
It's wonderful to have you as a neighbor, and it's a treat for me to be able to talk to your audience.
The treat is ours because really, I want us to have a conversation. You are a mortgage broker, and I already bragged about you in the introduction. Basically, that means that you arrange for people to get loans to purchase property. A lot of that being their first home. It's one of your expertise and your passions, helping people get their first home. So this is a very helpful service. And I want this to be, I know you're so good at educating people, and I know you're a mortgage broker with a big heart. And I want this to be a real educational experience because the thought of buying a property is it's overwhelming, and sometimes we don't have the right information. I'll tell you something, even just the thought of dealing with a mortgage broker when I was younger, Rich, my first experience with a mortgage broker was not so pleasant. It was almost up there with car salesman, if you know what I mean.
Yeah.
And you're nothing like that. So why don't we get started with you telling us, why is it so important to shop around for a broker itself? Like, what is the kind of person that we actually need to be looking for, who actually is going to care about our financial life and not just about selling us a loan?
That's a really great question. And I wish more people came into the mortgage process with that mentality. Oftentimes I speak with people who go to these low rate, almost self-service type websites. They get no expertise, they get no counsel, they get no advice. So they really have no idea. They go in there like, I want a 30-year mortgage, and they're like, okay, great. Here's your interest rate. Off you go. And that's it. That's not the experience. They don't get to learn about how do you attain wealth? How do you use your property best for you? What are your different options? And they don't even get advice as to whether or not this is good. They just get advice as to whether or not they qualify.
Right. So it's the qualifying, just a number, some indicators might say that you qualify, but I think what you're suggesting is there's a bigger picture that we need to look at. Is that so?
Absolutely. A couple of years ago, I was dealing with a young family. On paper, they qualified beautifully. Now, this young family, they didn't pay rent. They didn't, they had great jobs, they had good credit, but we could see that every single month their revolving debt was increasing. So even though they didn't have a housing expense, they were spending more money than they made every single month. And I counseled them. I said, look, I could approve you, but I can't. I can't morally do this because you're going to lose your home.
Wow.
You're going to lose your home within 6 months. And I'm going to tell you right now, she went to a different mortgage lender. They approved her for the home. She purchased the home, and I was wrong about 6 months. It was 8 months.
What?
It was 8 months. They didn't know how to budget. I had asked them, hey, let's go through an exercise where for the next 2 to 3 months, you follow the principles of a spending log. You save the amount that your projected mortgage payment is going to be each month. And they didn't wish to do that. They wanted instant gratification.
They wanted the house.
They wanted the house. They wanted to be home buyers, but they were not concerned about being homeowners. And there's a difference. Because if you buy a home that you can't afford, if you buy a home where the payment and the living expenses are going to be unsustainable, you're just a home buyer. You won't remain a homeowner.
What you just said is so eye-opening, because is it typical, Rich? And going back to the question about mortgage brokers, like, do you see other peers? And I mean, please, I hope the answer is yes, that there are others in the mortgage industry that approach this the way that you approached it with this couple and with all of your clients. I hope that's true.
I do know that there are a lot of lenders who do this, but I would say that we're still in the minority.
Wow.
Most often you're going to get a mortgage lender who's either a higher pressure salesperson or an order taker.
Or a what?
An order taker.
Mm-hmm.
They're not much different than a server at a restaurant. Oh, you want a steak? How do you want it cooked?
Mm-hmm. Mm-hmm.
And that's really not what you want. You want somebody who's going to challenge you and challenge your assumptions.
Mm-hmm, mm-hmm. Because again, it's somebody who understands that it's not about the home buying, the home purchase itself, but rather about home ownership, like you just said. So you mentioned that this couple, their debt was increasing. Let's go through the best practices. What do you like to see? What do you want people to have kind of ready that you could say, yes, I'm comfortable doing this for you. Let's do it. You're ready.
That's a tough question to answer, Yael,
Mm-hmm.
because everybody's situation is really different.
Okay, tell us.
I'm going to share with you. I helped a family with a 542 credit score,
Mm-hmm.
purchase a home.
That's pretty low,
542.
people. That's
That's
pretty low.
that's abhorrent. You have to normally work to get that.
Mm-hmm.
But I spoke to the family. I'm
Exactly.
like, what happened? How did you get that 542 score? I
Mm-hmm.
gotta know. And when I was looking through and listening to them, I saw there were a lot of medical collections.
Mm-hmm.
And there was an incident in their life that happened. It was a specific period of time. Beforehand, they had great credit. Afterwards, you could see they were trying to do things properly. But they had all of these medical collections that were eating their lunch.
Mm-hmm.
And we were able to figure out that, they're good people. They had a really difficult time. So we can help them.
So are you suggesting that it was still the right time for them? There was no, don't you think there may have been an opportunity for them to wait and improve their credit score? Like walk us a little bit more in this example.
So in this example, was there a better time? Would waiting have helped? They could have potentially gotten a little bit better interest rate had they waited.
Mm-hmm.
However, we were able to get them a monthly payment that was right around the payment that they were renting a home for.
Uh-huh.
So now they're putting money into equity every month rather than it all going to rent.
Mm-hmm.
These medical collections will eventually be settled, but it's going to be a matter of time. It may be a few years.
Right.
Do they really wish to be paying rent for that long and being exposed to rent increases?
And especially because you were seeing that there were other things that were in place that you were liking, like maybe there was no high credit card. Like tell us what else was in place that made it favorable in this situation.
So they look to be reasonable users and responsible users of credit. We saw that their credit cards weren't maxed out, that they were saving money every month. They had very stable jobs. Now, they did have a little bit of time off from work during the incident. So everything lined up.
So we're looking, so from your perspective, what are the things that we're looking at? If somebody's listening, they're saying, wow, I wish to own a home one day. So we're talking, you mentioned credit score. That's one piece of the puzzle. You mentioned how much you're spending, how your credit usage, right? You mentioned savings. Let's break these up.
So credit usage is a component of credit score. So if you're using more than 20% of the limit on your credit cards, your score drops.
Yes.
If you start using like 80%, your score drops precipitously. If you miss a payment, so let's say you've got a perfect credit history and you miss one payment, you're 30 days late once, your score can drop 60 points, 70 points for one 30-day late.
And that's going to impact, just so people understand, that's going to impact the interest rate that they're going to get.
That's going to impact your interest rate. That could impact your auto insurance. That could impact your homeowner's insurance. That could impact so many things. It can even impact the chance of you getting a promotion. So
Okay.
There's a lot that goes on with your credit score. Then let's talk about, I want to bust a huge myth right now.
Yeah.
Okay. There's a huge myth that you have to have 20% down to buy a home. Have you heard that before?
Yeah, of course.
If we all had to have 20% down to buy a home, we'd be able to buy a home by the time our kids graduated from college. That's a lot of money. You know, if a house is going for $300,000, you got to have $60,000 in the bank. Why would you want to be paying rent for so long? There are phenomenal programs that will let you purchase, depending on the purchase price, the property type, for with as little as 3 or 3.5% down. Now, the cost of the money, the interest on the money, and maybe the mortgage insurance may be a little bit higher.
I was going to say that because the bank wants to know that you have a cushion.
Yeah. The cost of the money may be a little bit higher. You may have to pay mortgage insurance. That's going to make the cost a little bit higher. But remember, you're putting away an equity every month. You're gaining price appreciation on your home, and you're not exposed to rent increases.
But I will play a little devil's advocate here.
I love it.
But then there's something to be said. We go back to the point of being a homeowner, right? There are a lot of expenses that most people don't factor in with owning a home. It's not just your mortgage payment. There are things that you're going to need to repair, not just when there's moving costs. There's so much that goes with, and once you're in the house, you have to have a cushion of savings to maintain that home and that ownership process. So I'm still not so comfortable with you don't need to have so much money in the bank. I don't know.
Well, no, we were talking about down payment,
right? But so I get that part about the down payment. You can get financing without having the 20%. Okay, fine. Maybe a little bit more expensive financing. But I guess that what I'm pushing on the point is it really fair to say or to have, because there's that myth, right? Like renting is throwing money down the toilet. And I don't know if that's so true, because I think that has driven a lot of people to make a really bad decision and get themselves into a mortgage that they can't afford. And I think there's a lot of caution to be had, and not just to jump into home ownership because I'm throwing money down the toilet. Well, maybe I'm not even ready. I don't know exactly what kind of property I would like to maintain. Like, there's so much to consider here.
So you're correct there. And so we haven't really talked about the rest of the money. We've only talked about the down payment.
Okay, so go for it.
Okay. Basically, there's something that my coach, I have a business coach, and the organization, they work very hard. They talk about the wealth attainment model. Okay. And these are the steps to help grow wealth. One is to try to get a home right around at the most 3 times your family's income. Okay. The second thing, and I actually like to flip these boxes, is to make certain that after you have your moving expenses, your closing costs, and your down payment, that you still have a minimum of 6 months of family living expenses. Most lenders don't even care about reserves anymore.
Really?
They don't. It's not a guideline for most loans. But you should have 6 months of living expenses. And when most lenders talk about reserves, they're only talking about your mortgage payment. They're not talking about everything. But okay, great. So you got 6 months of living expenses, but what are you going to be eating? Ramen for 6 months? That doesn't work. You need to be prepared.
Right.
Okay. Just 2 days ago.
So that's exactly, sorry to cut you off, but that's exactly what I'm saying. So you might be paying rent and you might be throwing money down the toilet, but if you don't, but you still haven't saved to have that, then I don't think you're ready. And you maybe on top of that, you're carrying credit card debts. So you're probably not ready to be it might be a nice thing to own a home, but you're financially not ready.
That's correct. However, if you have your 6 months of living expenses and you're still renting, your 6 months of living expenses, you have your down payment, you have your closing costs, you're going to be in the area for a little bit, 5 years, 7 years,
right?
And you're still renting, then you need to really think about things.
Right.
And if you're carrying a lot of credit card debt, there's a question. Are you carrying it or are you using it monthly? Our Costco card, we pay that thing off probably twice a month. But that's where we do all our spending because I get a rebate. But it's got to be manageable. If you've got, tens of thousands of dollars in credit card debt and you're only chipping away at the minimum payment every month, may not be a good idea.
Mm-hmm.
Now, one other thing I do wish to point out is many of the wonks, the folks who know a lot about real estate and properties, they're estimating that within the next year or so, the average rent is going to go up about $300 a door.
That is a lot of money for most people.
$300 for your apartment that you're renting, your condo you're renting, your home you're renting. And that's due to a few things. One, a lot of folks didn't raise rents during COVID.
Right.
Two, rampant inflation. In fact, this morning's numbers just came out. I think it was 7.6%.
Mm-hmm.
It's absolutely devastating. And the treasury markets, mortgage-backed security markets are reacting really poorly. Interest rates are going through the roof.
Mm-hmm.
And as they're doing that, that will also cause rents to increase because rent payments have been kept artificially low because mortgages were so cheap and people didn't want people to leave.
Mm-hmm. Right. So what this is suggesting is people, maybe it is time, regardless of the fact that the interest rates are going up, it might be time to really look at your finances and visit the possibility of purchasing a home.
It absolutely is. And, we're talking about interest rates being high. We're in the mid-fours. Back in the early 2000s, people would name all of their children, whether they've had them already or not had them yet, boys or girls, they would have named them after me if I could have gotten them a 6% interest rate.
Okay.
So these fours are great. My dad bought his house, I think it was 12.99.
Mm-hmm. Right. So, yeah. I remember.
Historically speaking, we're doing really well.
So this is an interesting twist to the conversation. I guess you are suggesting that it's that people take it seriously, and you just gave us the things in your estimation that we need to have in place. So don't worry so much about the down payment, but do make sure that you have a savings cushion. Do make sure that you are on top of your debt, that you know how to utilize credit, basically. And if there's something in your credit score, you need to be able to explain it, right? There needs to be
a good explanation, not, oh my gosh, I forgot that month.
Right.
That's just a crappy explanation.
Right. Rich, going back to something that you mentioned in terms of the quote unquote formula to build wealth, you mentioned buying a home that is 3 times or around 3 times your family's income. What's the magic formula there?
So it's really a rule of thumb, but generally speaking, and this is going back to the 7-8% interest rate times.
Mm-hmm.
If your home is right around 3 times your family's income, chances are that your payments are going to be low enough that you're going to still be able to have your savings. You're still going to be able to have, pay for all the different expenses that you have to pay for, be able to pay for your home and live a good life. Okay.
So we're looking at capping it at that, basically.
And once again, it's a rule of thumb. So don't take this and go, well, Rich said, because sometimes 3.25%, sometimes only, or 3.25 times, sometimes it's only 2 times. It really depends on your individual situation, but it's a general guideline.
Okay. Yeah, I know this is good. It's good to have a benchmark. All right. When we talk about refinancing mortgages, Rich, because you already mentioned you already mentioned that, people get comfortable with the 4%. It's not such a big deal, right? And there's this conversation also happening. Maybe those of us listening who already have a mortgage, there's a lot of talk of this might be, as interest rates are going to keep going up, it might be a good time to refinance, especially if you have a variable rate. So walk us through that, because I may have just pronounced words that people are like, what is she talking about?
Okay, that's a great question. Actually, I want to back up one step from your question. In the last week, at least twice a day, I've been hearing from home buyers, when can I refinance? Now, they don't even have the house picked out. We're working on getting the loan approved, and they're already thinking refinancing.
Wait, what? I don't get that. How's that? What's the logic here?
The logic is they're thinking that these 4% rates, the 4.5% rates, this market that we're in right now, they're thinking that this is the anomaly and sub 3% is the norm.
Oh,
So
I see.
I want to throw a bucket of ice water on you right now if you think that that's your perspective. We've been getting money on sale for most of the last 12 years.
Mm-hmm.
The average normal interest rates are going to be 6 to 8%.
Mm-hmm.
So don't think that just because you're buying a house at 4.5% that that rates are going to be 3% or 2.99 in the next year and change.
Well, yeah, that's certainly not the way it looks like. That's not happening, apparently.
It's not, or at least it doesn't seem like it would be, but we keep hearing that from customers. So don't be buying a house going, well, I can make this payment for a year, and then when rates go down, I'll refi. That's not happening. I don't want y'all to think that. Now, if you've got a rate that is an adjustable rate mortgage, it's absolutely time to lock it in. Even if your interest rate is going up, because we just see rates continuing to go up. The Fed chair, the president of the Fed, one of the presidents of the Fed today said that he wants to see 4 interest rate hikes before July.
Right.
And he said they may even do it between meetings.
Mm-hmm.
So the market is just absolutely spinning right now. We want to make certain that we can lock in our savings.
Right. So that is for those of us. So that is for people who have a variable rate, right?
Correct. Now, if you've got an adjustable rate that's above 6%, 5.5%, you also may want to look at refinancing depending on how long you're going to stay in the home.
Mm-hmm. Mm-hmm.
And if you've got, let's say you've got a 3% interest rate, but you've got a home equity line of credit that's got a huge balance and it's not fixed, you also want to look at that as well, because you don't want to be in a situation where you can have that part of your mortgage spiral out of control.
Wow, this is an important point. Okay, so now here's my next question, and I know this might not be your your expertise, but still you are in the real estate market. So we talked about the cost of borrowing, and we talked about what to do about that. And you talked about the renters, the price of renting to go up. What are we going to be seeing in terms of real estate prices, purchasing homes? Because we've just been seeing prices go up, 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 up. So is that going to continue, or is this going to settle down a little bit? What do you think?
It's a really great question, and it's a difficult one to answer with certainty. Mm-hmm. By the way, if anybody tells you they have the right answer, I would run. I've been listening to forecasts from different people. Number one, let's talk about the elephant in the room. Mm-hmm. This is not 2008.
Thank you. Okay.
This is not 2008. The fundamentals behind what happened in the real estate market in 2008 were entirely different. Mm-hmm. At that time, you almost didn't need a pulse in order to get a loan. There were these crazy loan products out there where people were able to purchase a home and get cash back.
Uh-huh.
So you'd go out in California, you'd buy a $500,000 home, you'd get a loan for $625,000, walk away from the closing table with $100,000.
Wow. Yeah, it was crazy.
And so you're like, oh, hey, I don't have enough money. Let's go buy a bigger house. Mm-hmm. And this would happen over and over again. Mm-hmm. That was part of what was pushing the price appreciation then, was just the relative ease of getting credit without having any sort of credentials, without having good credit, without having to prove income, assets, etc. This market, we've been a lot more conservative when it comes to the loans that we're doing. Mm-hmm. And this market, let's talk about Greater Houston. I realize this is like an international podcast. Yeah. I'm more into the market in Greater Houston.
Let's talk about Houston. By the way, we love Houston, people, if you want to live in Houston. And it's funny that we're having this conversation, because when I reacted to your, well, you don't have to have 20% down. You don't have to put 20% down. My brain went to 2008. What do you mean you don't have to put 20% down? That's crazy.
So Greater Houston, we have a challenge here. We have not been building enough homes since 2008. We've only been building at 12 to 15% of the needed new homes for our organic population growth. That doesn't include all of the people who are running to Texas from places like California and New York. Like me, I came from California back in 2002.
Right.
All these folks who are coming in here, we're also not building enough homes for them. So we are years behind in inventory. We did for a while have a glut of apartments, but that's really been taken out as well. So we have a very tight market. We're going to continue to see appreciation. They're estimating in Greater Houston 11 to 17% just this year, despite increasing interest rates.
Wow.
And 3 to 5% per year thereafter for the next 7 to 11 years.
Wow.
And just to give you a little context, that those projections come from a mortgage insurance company, a PMI company. They're the ones to take a first loss on any loan that goes into foreclosure. They're the most conservative. They're the ones that were calling the 2008 crisis back in 2005 and 6. So
I guess what you're saying is good news for you and I, because we own property in Houston.
It's great news for us. And I think that we are going to continue to see property values increasing relatively across the nation. The big question is, are wages going to keep up? Right. And will the Fed be able to control inflation to a point that people are not going to be priced out of living? Folks who were barely qualifying for homes when they bought them the last 2 years, with the cost of food going up, the cost of gas going up, the cost of groceries going up, that's going to be more challenging.
It's not all doomsdays, people. It's not.
It's not. No. No, and I'm actually I'm an optimistic guy.
I know you.
I think that we're doing great things for folks, but we have to be cognizant of the fact that prices are going up.
Right. So people, we got to get creative and start making more money.
Yeah.
So talking about that, let's talk about your upbringing with money, because as you know, so much of the way we think and we speak and we behave about money has to do with what we saw in childhood, what we experienced. So what are some of the lessons that you learned about money growing up, whether negative or positive, that you feel have shaped the way you are with money today?
I think the first and biggest lesson was make more money.
What we just said. Tell us more. How?
So I come from an entrepreneurial family. Almost everybody in my family were self-employed. They had their own business. They're salespeople. We wake up and we breathe, how do I create an opportunity today? That is just, so that's sort of been ground into my bones. And we're really excited to make opportunities. Now, how has my perspective shifted though? I used to chase the money. And that's like having the worst breath in the world. Nobody wants to be within 20 feet of you if you're chasing the money. I was going over my goals with my coach earlier this year.
Yeah.
And my goal was not focused on how much money I could make. He was actually really surprised because my focus was on how much tzedakah I could give.
Isn't that such a powerful motivator?
It really is. And it's like, okay, if I can give this much tzedakah, everything else is going to take care of itself.
Of course.
And so that was one of the things that was not really hammered into my head as a child. It was something I came to later on in life, thank God. The other part is that you have to work hard. You cannot be afraid of hard work. But you have to love the work that you're doing, or every day is going to suck. Yes,
so important. Which brings me to, how did you then end up in the field of, because I know, again, it just listening to you in this conversation, you're so passionate about helping people get the right loan for their family and helping them go through the process of home ownership. How did you get into this?
I got laid off.
Okay, talk more. Sometimes God does the best things for us, right?
Exactly. I was working for a commercial bank. I was laid off. I was laid off 11 months before my entry into the Bear Stearns Junior Investment Banker Program.
I know it very well. Very familiar with the program because I worked across the street. So either my best friend was in the program and I was in the program across the street. So there we go.
Yeah, so the program was supposed to start in June. I got laid off on July.
Mm-hmm.
And I was like, okay, well, I need to be able to do something. What can I do for just a few months? So I'll become a mortgage lender.
What?
I did that. Yeah, that's what I did.
Uh-huh.
I couldn't figure out anything else. I'm like, I'll just become a mortgage lender. And I actually spoke to the guy who hired me. And he said his biggest fear was that I was going to look for a better job and leave within a few months. It turns out I loved what I was doing. I loved helping families establish themselves. I loved helping build communities, build security and safety so much that I've never looked back.
Mm. You told me once that your family tended to move a lot when you were a child. Is that so?
We did. We moved a ton. And in addition to that, my parents were divorced. They lived about an hour from each other. So I would spend a weekend at mom's, a weekend at dad's, a weekend at mom's, a weekend at dad's. It was tough to make friends when you're never consistently anywhere. There was, no little league. In fact, I remember one year I took my $5 allowance and I went to the local park and I signed up for the summer little league. And my parents were like, you can't do that. Can't do that. And so I think that if we help people get a home, if we help them get something that's affordable so that this way they don't have financial struggles, which create a lot of stress in a marriage, and that creates a lot of family breakup. If we can help them do that, then kids are going to have a much better life. And it's just creating better futures for our kids, our community, our country.
Beautiful, beautiful. Now it can't be that you were so perfect and so savvy since you're a kid. You gotta tell us some challenges or failures with money that you've had to overcome. I mean, the credit card payment miss. Please tell us.
July 7th of 2008.
Oh no, you know the date. Okay, what is it?
I lost absolutely everything.
What? Okay, what happened?
Everything. It was like a really bad country music song. I was working for IndyMac Bank, and we were just about to be sold to another company. It was going to be great. We were going to be doing really well. And we were called onto a conference call. The bank was taken over. It was taken over by the FDIC. Now, not being smart about money at the time, I did not diversify. I had all of my money in either the 401k invested in IndyMac. Because I loved the company and I believed in it. Oh, it gets worse. Yeah, it gets so much worse. They also had
let me just even break that further for listeners. Okay. What he just said is that all of his investments, his long-term investments were in shares of his employer.
Oh, it gets worse though. We also had a non-qualified retirement plan. And that non-qualified retirement plan, you could put as much money as you wanted in. There was no $19,500 limit. And that was also all invested in the company.
Oh my gosh.
So I lost low, mid 7 figures that day. Plus I lost my job, my insurance. And, I was trying to be really responsible. I was only taking a very small cut of my commission and putting everything else back into savings. I lost it all.
Wow.
And that was the best day of my life. Because I realized that was the day that I started realizing that it comes from Hashem and not from me.
And yet, what that is a big realization and a powerful lesson.
That was an expensive one.
It's an expensive one. Yeah. But does that negate the saving and investing?
So it doesn't negate the saving and investing, but you have to be smart about it. You need to diversify. I'm not a financial planner. I don't play one on TV. Okay. But what I can say is you need to have diversified investments. Don't put all your eggs in one basket.
But also it sounds like you weren't liquid, like you were investing all your money. So you had a really supposedly solid, you thought it was solid long-term plan. But if you lost your income, you didn't have that cushion that you just told us 10 minutes ago, you want people to have.
So I had a very small cushion.
Mm-hmm.
And laughably small, probably 2 or 3 months.
Right.
And 2 or 3 months isn't going to get you far when you have to figure out, okay, everything I've been doing has changed, because I used to be the guy who would buy loans from mortgage lenders.
Mm-hmm.
So going out and starting as a retail loan officer again,
Mm-hmm.
trying to help folks, that was extremely challenging because everybody I knew was my competition.
Mm-hmm. Mm-hmm.
So I had to start all over, and it's been a beautiful journey.
Wow. Yeah, the entrepreneurial journey. So what now? What happened now when you finally got back on, when you started changing your life right then? Like, how did you rebuild it? Like, did you start saving aggressively? Like, walk us through that process of, like you said before, that you're very into building wealth. So what did that process look like for you at the beginning?
Let's see. At the beginning, it looked like essentially having to couch surf
Mm-hmm.
for a little bit, trying to establish my business and failing multiple times.
Mm-hmm.
Absolutely wonderful.
Mm-hmm.
Not at the time. At the time, it really sucked.
Right.
But it's wonderful. The first thing I do is I max out my 401k, because it really takes very little out of my check.
Mm-hmm.
So I don't even notice that.
Mm-hmm.
The next thing is I like to have money squirreled away, whether it's pictures of dead dudes on paper, whether it's in different accounts that are a little bit more challenging for me to get to, because I don't want my money to be too liquid, or I might do something stupid.
Right.
I want it to be 2 or 3 days for me to get it.
Yeah. I don't want it at arm's length.
Yeah, I don't want to cool. I need a cooling off period.
Yeah. No, that's very smart, especially when we're talking about that cushion. Like, that cushion is not for when you have an impulse to buy. You want to have it
not
away.
for the new TV.
Yeah, it's not for the new TV. It's for you to think through things. Although, then when we want something, then we could have a shorter term cushion for a specific goal. You want a new TV, so have a sub account just for your new TV.
We're actually doing something similar with a cruise that we want to take next year.
There you go. You plan for it, and that's money that's been set aside. So you talked about the concept of charity and that becoming a really big why and motivator. I'm curious, how do you think overall your Jewish observance has impacted your money mindset and your management, and maybe even that career, the way you work in business?
I think that the way that it really has impacted me most is that I'm not looking at me. I'm not looking at me. I'm not looking at what I can get. In fact, you can attest to this, because I'm sure you've heard stories about where I told people no.
Yeah.
Where I've said, hey, refinancing is not a great idea for you, or buying this house isn't a great idea for you. I'm not thinking about, hey, how can I make money? I'm thinking about, hey, how can I help somebody better? And part of that is just that, we have to give good counsel. And it says, it says, don't curse the deaf or put a stumbling block before the blind.
Right.
And I realized that in my practice as a mortgage lender, those who come to me are mostly deaf and blind. Yeah. And so I have to be very clear, and I have to clear the path for them to enable them to make their right choices.
It's so refreshing. It's so beautiful to hear. And I'm sure you can attest to the fact that it's probably brought you so much more money at the end of the day, right? It's that you're not missing out. You're not, by doing the right thing, right? And trusting that the money's not coming from that person. I still have to do the right thing for them. I'm here to serve them. The money's coming from God, so it's not going to be an obstacle.
So, I don't look at it as the money coming to me. I look at it it's that much more tzedakah I can give.
Mm-hmm.
One of the neatest things, I remember a few years ago, I was so excited. I messaged my manager. I was like, hey, I was just doing my tzedakah donations for the year, and we were able to give 22,000.
Mm-hmm.
And that was just the most exciting feeling. And thank God, we've been able to increase. And now I'm actually looking at having to get more strategic,
Mm-hmm.
because I feel like I've been using my tzedakah like margarine on toast. And
Mm.
I've been spreading it thin everywhere and really not having, Shoshana and I have really not had the impact that we could have by being more strategic with our tzedakah.
Wow, that's so amazing to hear. So Rich, before I wrap it up with the Jewish Money Matters fill in the blanks, what if you could leave listeners who are thinking of purchasing their first home with like just a nugget of your wisdom, what do you want them to take away?
If you're not nervous about buying a home, you haven't thought about it enough.
Aha, very nice.
And there's a book that you recommended to me years ago that actually incorporates a lot of the exercises that I've had my customers doing for years.
Mm-hmm.
The Latte Factor by David Bach.
Oh yeah, I love the Latte Factor. Yes.
I absolutely love that. And it's amazing because I was reading through it, and things like the money leaks and the spending logs, those are exercises that I've had folks doing since basically back in 2009.
Wow.
And I think that it's one of the most amazing things you can do for yourself and for your family. Without that, you really don't know what you can afford.
Hmm. Right. Yeah. So looking at those numbers, that it can be so scary for so many people, so many of us, I'm not going to deny that at some point in my life, it's been terrifying. Right. But I think there's so much clarity that comes with it, and it's so empowering.
You're right. And one of the things is, like, let's say chas v'shalom that somebody finds a lump when they're doing a self-exam.
Yeah.
Okay. If you don't go to the doctor and find out what it is, number one, you're going to live with the dread. Number two is, God forbid, it could only get worse.
Yes.
If you don't look at your numbers and figure out where you are, it's only going to get worse, and you're going to be dreading it as it's getting worse.
Yeah. Yeah.
When I talk to somebody and I'm like, hey, so how's your credit? And they say, I don't know. I haven't looked at my score in years. I automatically know how their credit is, because they're afraid of that lump.
Mm-hmm. Mm-hmm. Yeah. And I like what you said, because you said if you're not nervous and you haven't thought about it enough, it should be, it's like when you embark in a project, right? There's like that nervous feeling that you're doing something important. So I think that's what you're suggesting. Understand that you're about to embark on something important. You have to take it seriously.
Well, think about it this way too. It's like a shidduch, right? It's like dating, because you're about to marry a 30-year mortgage.
Yeah. True. Now, before we do the fill in the blanks, why don't you tell me some of the financial habits that you practice, quote unquote, almost religiously?
So here are the things that I do. Number one is I don't let myself control my money. What does that mean?
Yeah, what does that mean?
So when I am paid, being that I'm a mortgage banker, I get paid a couple times a month.
Mm-hmm.
Whatever I've made for that, for that pay period, it comes into my check automatically. 10% goes to my 401k, 10% goes to investments. So that's 20% out.
Mm-hmm.
Then I've got some that go to my Meiser account.
Mm-hmm.
Okay, 10%. And one thing that I have that's a bad habit is I overspend my Meiser.
What do you mean? You give more than 10%? Is that what you're suggesting?
I do. Because it feels so good.
Mm-hmm.
That I lose track of it. And that's really, that's not a smart thing to do, because it says that you even have to be, even if you're giving over 10%, you can't be doing it by estimate.
Yeah, you can't estimate it. Yeah. And most of us should not be giving more than 20%, like only if you're very ultra wealthy.
Rambam says that if you give more than 20, you're a fool and you're going to lose everything.
Mm-hmm. Mm-hmm.
So I think that Rambam was even talking about the ultra wealthy. I don't know.
Okay, so now you know. So wait, so do you have it automated just like you have the investing and the investment and the retirement?
So that goes into the account.
Oh.
Now, I don't automate the giving because, thank God we live in a community where people come by and they collect. And I don't know about you, my phone rings off the hook
Yeah.
with different Chabad houses and shluchim and mikvah projects. And so I've been really like, I give to every one of them. And I'm looking at it now and saying, I'm not having the impact that we should have. We need to be a lot more intentional about our tzedakah.
Okay, so what are the other habits?
The other habits that we have are that I like to pay my credit. I want to make sure that it's done early. I like to keep the balances low. I do spit off a little bit of money every month that goes into my reserve account.
You mean your cash reserve?
Yes. And then the other thing that we do that I think is extremely important is I put away for unintended owing the IRS extra money. Because if they ask for it, I've got to be able to give it to them and fast.
So let's do a little bit of the Jewish Money Matters fill in the blanks. And this is a part of the show where I'm going to ask you I'm going to tell you an open-ended statement, and you'll finish it with the first thing that comes to mind. Okay.
Okay.
When I give meiser or tzedakah, I like to give to
everybody.
People, whose door to knock on.
The thing is, as I said, we've got to get more intentional. So I have to focus on making a better impact rather than just giving to everybody with their hand out.
I'd love to make more money because
I can help more people, help more families, give more tzedakah.
Something I wish I'd learned about money growing up is
money is a tool, not a goal.
Nice. Yeah, it's a big mindset shift for so many of us, right?
It really is.
Yeah. Especially we grew up in the 80s and 90s. Like it was a goal, man.
Yeah, it was. I mean, what was that movie, Wall Street? Greed is good.
Wall Street, and we all ended up working in Wall Street. All right.
No. I didn't get there. Remember?
You didn't. You were lucky you didn't get there. You were on your way. I was there. No hard feelings, Wall Street. No hard feelings. Okay. Money, spiritual or physical?
That depends on you.
Nice.
That depends on you. I mean, physical, okay, if that's what you want to use it for, yeah. But if you want to use it to help others, to give tzedakah, to help build institutions, then absolutely spiritual.
Something I splurge on unapologetically is
good coffee beans. Life is too short for bad coffee.
Oh, life is too short for bad coffee. Yeah, my father would have liked you. Spender or saver?
Yes.
Both, ma'am.
Both. This is why I automate. It's why I automate, because this way it limits the amount of spending that I can do and make certain that I meet my minimum savings goals.
Yeah. We don't have to rely on will, people. Why rely on our willpower if it's not so great?
Even if it is great, why rely on it? You can use it for other things.
Yeah, I like that. Exactly. Use it for other things. Yes, I like that. Today, I'm most grateful for
my wife.
Oh, good for you. And finally,
she's holding a shotgun to my head right now when you ask that question. No, I am. I mean, I know that a lot of my bracha, a lot of the blessings I have come in the merit of my wife. And without her support, without her backing me on all these crazy things that I like to do, I wouldn't be able to do it.
It didn't sound so crazy, but let's not get into details. I don't know what crazy things, but this sounded pretty smart and rational to me.
Well, some hours are exceptional.
Finally, I'm Rich Bonn, and I believe Jewish money matters because
so I believe that Jewish money matters because the way that you choose to use this gift that's given to us by God determines a lot of the legacy that you leave.
Yeah.
If you decide that you just want to take the money and get the biggest, best, newest, whatever, your legacy is going to be in a landfill.
Mm-hmm.
But if you take this money, this bracha, this blessing that God has given us, and you use it to help support wonderful institutions, to build up people, to help support folks, even maybe help them start a business, what have you, then your legacy will live on forever.
Love that. Thank you so, so much. And listeners, this is the time to think about home buying. Apparently, do it pronto. If you need help, you can contact Rich Bonn, especially if you are in the Houston area. Rich, I didn't mention, but you also have a book, and I think you have a gift for listeners that we're going to make available also for them. So tell us a little bit about that.
So when COVID started, I decided I had to write the book that I've always wanted to write, which is a first-time home buyer's guide.
So needed.
And it's more specific to the greater Houston market, but a lot of the lessons apply wherever you are. And so for the first 20 people who fill out the form, and the link for the form is going to be in the podcast notes, I will send them a copy of my book, Buy a Home, Be a Hero. Or if they want in Spanish, and Yael, thank you so much for proofreading this for me.
I did.
Compra un casa se no.
Oh, very nice. Very nice.
And I absolutely would love y'all to be able to get that information. It's just, to me, it's so important to be able to educate folks. Even if you go use a different lender, as long as you're walking in educated.
Exactly.
Because this way you're going to be able to make a great impact on the rest of your life.
Yes. This is one of the biggest purchases that you'll be making, one of the biggest investments. So we want to make sure that people walk into that with education. And like you said, it's not about the buying, it's about the ownership.
Exactly. And the ownership is also secondary to, because a house is just a structure. It's what's inside the walls that's a home.
Right. Right. Exactly. The impact it has in your quality of life and your relationships, everything that happens within those walls. Beautiful. Thank you so much, Rich Bonn. This was such a pleasure. Thank you so much.
Thank you, Yael.